So today I want to talk to you about something that I haven't seen talked about a lot, but something I think is very helpful for people that have been or that are currently in a home, and that's something that's called a loan modification. This is something that actually didn't always exist. So it really came about after the 2008 real estate crash when you had a lot of houses in foreclosure, a lot of people losing their homes. Inventory of foreclosed homes was extremely high. And for those of you that don't know, banks want to own your mortgage. They don't want to own your house. So they want you to be in a position where you're going to make your monthly payments and they're going to make money off the interest that you pay on a monthly basis, along with the principal that goes back on their balance sheets. So one of the things that they did, or what came about from that crash, is actually two things. One is a loan modification, which is what I'm going to talk about in this video. The other one is a forbearance. Two different things. I'll talk about forbearance later. Let's just stick to the loan modification. So basically what happens is life happens, right? You're making your payments. Let's say you got laid off, you lose your job, you get unemployed, or just something unexpected happens and you got to put your resources somewhere else. Then you begin to fall behind on your mortgage. Most times, you can pay partial payments up until about 3 months to be able to try to get caught up. After 3 months, it's it's kind of like a linchpin marker, 90, 120 days. It gets transferred over from regular servicing to now you're in default, and the bank can start into foreclosure proceedings, right? So that's when they hire an attorney, they get an appraisal done on your property, and they start filing with whatever district or county court where your house is located in, so that they can start a process of reclaiming the property, so they can get the asset, sell it, and get the money back. And so what a loan modification is, it is the ability for you to be able to modify your mortgage. Let's just say you fell 6 months behind and you now found a job. That is probably one of the key things. If you're unemployed and you find a job, or if your circumstances were at the place where you didn't have the additional funds, you had to allocate them to somewhere else. Now you've gotten caught back up. You can go for what's called a loan modification. In that case, you fill out paperwork with the bank. Typically, they're going to want your pay stubs to show that you are employed, to make sure that you're making enough money to be able to afford the monthly payments. And they have an internal review process. And through that process, they can do a couple of things. So they can re-amortize your loan. So let's just say you were 10 years into a 30-year mortgage. They may re-amortize your loan, put what you owe or what you were behind on the end of the loan, and they can re-amortize it over another 30-year period, which would actually, depending on what rates were when you bought your house, could possibly substantially reduce what your monthly payment is. Again, going back to the banks don't want to own your home. They want you to stay in there, and they want to make money off of the interest and principal as you pay on a monthly basis. The other thing that can happen is, which I've seen, is that they can re-amortize your loan in order to make the payments more affordable. They can even stretch it out over more than a 30-year term. I've seen in some instances where they've kept the rate the same, or they've lowered the rate, but they expanded the time frame. So it allows the bank to make more money off of your loan over time. So instead of getting a re-amortized loan at 30 years, they'll do it over 40 years. They may lower the interest rate, but now they've got you in a position where they can collect money from you over a course of time. Now, in most scenarios, when you do a loan modification, there's no strings attached. It's just the bank trying to work with you. So it does work with you to be able to keep you in your home. So it doesn't stop you from being able to refinance, to a shorter term frame, once you are able to build up your reserves, and your credit score. Because obviously your credit score is taking a hit. It's gonna be hard for you to refinance right away because you've been behind on your mortgage payments. And so, I wanted to make sure I shared that, because that is something that is in place, that does work, that can help keep people in their home, that I don't think is talked about enough. And in most cases, all you got to do is call whoever your loan servicing company is right now. That's whoever you pay on a monthly basis. And, if you're falling behind and you've, got back on track, just ask them for a loan modification. They'll email you the paperwork. You just have to fill it out and attach and send it back to them attached with whatever they're asking for. And that's how you start the process. And usually it takes, I would say, 30 to 60 days to get things worked out. But if they know you're working on it, it can also buy you time. Sometimes they can take, if your property is scheduled to go to, sheriff's sale or foreclosure, they can stay that process. They can delay it and wait for your paperwork to come in if you've already started submitting it. A lot of times, the only thing that will trigger that is the initial application with a pay stub. So if you send those two things in, they see that you're employed, and you explain what your hardship is. A lot of times that's enough for them to trigger on internally, kind of a stop on the foreclosure process, just to be able to review your file to make sure that you can qualify for more modification. So hope you find this information helpful. If you're watching this video, please share it, like, comment on it. Just want to help somebody who needs it.